So when we learn GST, there's this one simple rule, right? The person who supplies the goods or services pays the tax. But what if I told you there's a massive curveball, a twist that the ICAI loves to use, where that entire rule gets flipped on its head? A situation where you, the person receiving the service, have to pay the tax. Let's break down this exact exam trap.
Okay, take a look at this. This is a classic exam-style question. You've got a registered law firm giving advice to a registered company. On the surface, it seems pretty straightforward. So, who pays the GST? Take a second. What's your gut reaction? Go ahead, lock in your answer.
So, did you go with option A? Did you think, well, obviously the supplier, Advocate Legal Services, has to pay the tax? And hey, if you did, you're in good company. It's the most logical, most common answer. It just feels right.
And that is exactly the trap. This is one of those spots where so many students bleed marks, not because they're clueless, but because they miss this one crucial twist. Today, we're going to make sure you sidestep this trap completely. All right, let's get right into it. Why is that trap so effective? Why do we fall for it? It's all because our brains are hardwired to think about the default setting in GST. Okay, so normally, GST works on what we call forward charge. That's the default. You can see it on the left. The supplier sends an invoice, collects the tax from you, the recipient, and then pays it to the government. Easy. But the twist on the right is the reverse charge. The whole flow gets broken. The recipient, that's you completely bypass the supplier and pay the tax directly to the government. The supplier is literally out of the loop on the tax payment.
So this whole twist has a name. And honestly, it's a total game changer for your GST paper. It's called the reverse charge mechanism, or RCM for short.
And here's the official definition. But don't worry, it's not as scary as it looks. Section 298 just says it's when the liability to pay tax falls on the recipient instead of the supplier. That's really it. The name says it all. The charge is literally put in reverse. Okay, so the million-dollar question is, when does this rule even apply? We can't just use it whenever we want. The law is super specific, and you better believe this is exactly what the ICAI loves to test. Let's dive into the nuts and bolts. We're talking about Section 9, Subsection 3 of the CGST Act. This is the big one. This is your go-to section for the most common RCM cases you're going to see in your exams.
The logic here is actually like a simple recipe. The government publishes a special list of services. If one of those services is provided to a specific type of recipient, then bam, RCM applies. It's all about that combo. But here, this last point is everything. This is the key. RCM under this section kicks in even if the supplier is registered for GST. That's the core of the trap. Burn that into your brain.
Let's look at a few classic examples you'll see on the exam. Take a goods transport agency, or GTA. If they provide a service to a company, RCM is triggered. Or legal services from an advocate to any business entity, RCM applies. See the pattern here? It's always this special combo of the service, the supplier, and the recipient that activates the reverse charge. All right, here's a massive exam tip. Get ready for this. When you see a question that smells like it could be RCM under Section 9.3, your brain needs to immediately focus on just two things. What is the service and who is the recipient? Forget about the supplier's registration for a moment. It's a distraction. Okay, we've got the knowledge, we've got the framework. Let's go back to that first question and solve it the right way. It's time to defuse that ICAI trap. All right, here it is again. Registered law firm, registered company, who pays? But now, with what we know about RCM, suddenly option B, the recipient, XYZ Limited, starts to look a whole lot better, doesn't it? And that's our answer.
So, let's break down exactly why. Let's run it through our mental checklist. Step 1. What's the service? It's legal services from a firm of advocates. Is that on the government special list? Yes, it is. Check. Step 2. Who's the recipient? It's XYZ Ltd, a business entity. Is that a specified recipient for legal services? Yes, it is. Check. So what's the conclusion? Boom. Both conditions are met. RCM applies, and XYZ Ltd has to pay the GST. See how easy it is when you have the right framework?
You know, at the end of the day, what this really shows us is that the key to passing your GST exam isn't just memorizing the rules. It's about knowing exactly when those rules get turned upside down. It's about knowing when they reverse.
Okay, picture this. You're in the exam hall. You see a question on a topic you thought you totally had down, but then you look at the options and they're all super confusing. That sinking feeling in your stomach? Yeah, we've all been there. Well, today, we're going to turn that fear into pure confidence because we are cracking one of ICAI's absolute favorite topics. So let's jump straight in with a question that could be right out of your paper. Check it out. Aladdin Electronics, they did 90 lakh in turnover last year. Now they're in the composition scheme and they want to add repair services. The question is, what's the absolute max value of services they can provide this year? Is it 5 lakh, 4.5 lakh, 10 lakh, or 9 lakh? Go ahead, take a guess. This is a classic ICAI trap. It's designed to test if you really understand the concept, not just the surface level stuff. And the correct answer is D, 9 lakh rupees. Now, if you picked something else, seriously, don't sweat it. You've just stumbled into one of the most common traps they set. And that's exactly what we're going to clear up today. We're breaking down the GST composition levy, focusing laser sharp on the little details that cost students the most marks. Section 10 offers a simpler, alternative way for smaller taxpayers to handle their GST. The whole point is just to make life easier, to slash the paperwork and bring down those compliance headaches. And you can see why it's so tempting, right? Instead of getting buried in monthly filings, you get one simple annual return. You pay your tax quarterly, and you don't have to keep a super detailed, elaborate set of books. It sounds like the easy mode for GST, but getting into this easy mode, that's where it gets a little tricky. All right, so who actually gets to pick this easy option? This is where the game really begins. Understanding the eligibility, the fine print, that's where ICAI loves to hide its trick questions. If you master this, you're going to be way ahead of the curve. So the first hurdle, the main gatekeeper, is your turnover. To even be considered for the scheme, your aggregate turnover in the financial year before this one, the preceding year, has to be 1.5 crore rupees or less. That's the entry ticket. Seems simple enough, but hold on, there's more to it. And this is so important. This slide shows you who's in the club and who's not. On the left, you've got your typical members, suppliers of goods within a state and restaurants. But look to the right. This is your exam cheat sheet right here. If you sell goods to another state, even once, you're out. If you manufacture things like pan masala or ice cream, you're out. Sell stuff through an e-commerce site, you're out. These are the lines that ICAI loves to blur in their questions. And here it is, a perfect example of an ICAI twist. You have to read the words carefully. Someone who just trades pan masala, buys and sells it, they can be eligible. But the moment you manufacture it, you're immediately disqualified. It's a tiny difference in wording that completely changes the answer. That's a guaranteed MCQ right there. Okay, we've figured out who can get in. Now let's talk about the next big trap. And honestly, this is probably where most marks are lost on calculation questions. It's all about knowing that there are two different turnover figures you need to worry about. First up, for eligibility, just to see if you can even get in the door. For this, we look at the aggregate turnover from the previous financial year. That's its only job. It's the key that lets you into the scheme, nothing more. But once you're in and it's time to actually calculate the tax you owe for this year, you use a totally different number. You use the turnover in state for the current financial year. The past got you in, but the present determines what you pay. You guys, I cannot say this enough. This is a red flag alert. This is where marks go to die. Please do not mix these two up. Using last year's turnover to calculate this year's tax is the #1 mistake people make. Just burn this into your brain. Preceding year is for eligibility, current year is for tax. That's it. So now that we've cleared that up, we understand who's eligible and the two different turnovers, let's go back to our friend Aladdin Electronics and solve that puzzle the right way, step by step. So remember the problem, right? Aladdin sells goods, but wants to do some repairs on the side. And the law says, yeah, that's cool. A composition dealer who mainly sells goods can also provide a small amount of services. We call this the marginal services rule, and there's a very specific formula to figure out the limit. Here's how you do it. 3 easy steps. First, take 10% of the aggregate turnover from last year. Step 2, put that number right next to a flat 5 lakh rupees. And step 3, and this is the whole key to the question, you pick whichever one is higher. So let's plug in the numbers for Aladdin. Their turnover last year was 90 lakh. Step 1, 10% of 90 lakh is 9 lakh. Step 2, we compare 9 lakh to 5 lakh. Step 3, which one's bigger? 9 lakh, of course. And boom, there's your answer. It's that simple. So you see, the trap in that MCQ was designed to check one tiny thing. Did you remember the rule is whichever is higher? It's so easy to just calculate the 10% and stop, or to instinctively think you should pick the lower, more restrictive amount. But no,
The law gives a benefit here, and you get to take the higher of the two values.
So, let's wrap this up. What are the 3 big things you need to remember for your exam? Trap number 1. Know the difference between aggregate turnover for getting in and turnover in state for paying tax. Trap 2. Watch the wording. A trader of pan masala is okay, a manufacturer is not. And trap number 3. For those extra services, the limit is always the higher of 10% of last year's turnover or 5 lakhs. If you can remember these 3 things, you've totally cracked the composition levy code.